Hey there, it's Jayden Vecchio and Nathan from Hunter Galloway here. So today we're talking about assessing and planning your first home, saying you're about 9 to 12 months out. Now we know that buying a home's a huge deal and it's a really exciting time and things to look forward to. But between just going out there and finding the right home or deciding whether you buy a unit or a house, there's a kind of less exciting aspect to consider, and that's how you're going to finance the purchase. So the truth is, the further you plan ahead on how you're going to buy it, how you're going to deposit it, and how you're going to be able to afford it, the better you're going to end up in the end. So today we're going to go through what to consider, when you've got a bit of time out. You've got to think about what's your why you're looking at buying the property, and what the important parts are to think about. We'll look at the affordability side, how much you can afford, what deposit you're going to need, what income you need, and practically what that looks like. And then lastly, we'll look at the most important, almost even more important than that, how you're going to get the money. So what the banks look at and what their most important parts are. All right, so let's dive straight in. So the first thing to consider is, are you mentally ready? And I guess I see this as, what's your why? The reality is buying a property, it's a big thing. It can be one of the biggest purchases in your life. And just to get to that area of being able to purchase takes a long time. I remember, I even read a recent stat that a survey conducted by one of the big banks said that on average you'll spend about $600 in researching and doing different reports just to buy a property. So are you ready to spend that much per property if you're not quite ready? Nathan, I know in your case, it took you ages to find the right property. And what was that like? And what was your reason for buying?
Yeah, I think for a lot of first homeowners, it can be quite daunting. Even the thought of having a very large debt in your name and not really knowing what it'll be like, especially if you haven't rented before, you're buying your first home, having lived with your family, the costs ongoing. There's a lot of things to consider. So I think preparing mentally and being ready to purchase is important, particularly when you're looking quite far out from wanting to purchase your first home.
And I think just some simple questions at this point you can ask yourself when you're still in the sort of stage of considering a buy. It's, a lot of people, I know when I was young, I was moving around a lot, but if you buy, can you commit to staying in that same suburb or house for a while? Are you ready to take on some of those extra expenses that owning a home have, like repairs and insurance and body corporate? And are you ready to kind of settle down a bit, I guess? So they're all pretty important things just to consider and make sure that you're mentally ready for that debt. The next thing along to think about or to consider right now is, are you financially ready? So that really means getting a sense on how much you can afford, and get an understanding if you can really pay for that loan repayment.
Yeah, and if you're renting at the moment, calculate the cost of how much your rent is as opposed to when you'll buy your own property. In a lot of cases, when you're renting, you'll cover the electricity, the water. The things you won't be covering are things like rates if it's a unit, body corporate. So getting yourself financially ready for the extra costs associated with a purchase is important. Now, remember, you may be saving a deposit at the moment. Once you own your property, that's one thing you won't be doing. So when you look at it from a high level overview, getting yourself financially ready will help you alleviate those nerves and get you feeling even more confident about the process.
Well, I reckon you've made a really good point there, because owning a home is just so much more than that monthly repayment. So I think it's really important to think about having emergency savings in your bank there, especially once you're a homeowner, because if you don't, you're not going to be able to afford those surprise repairs if the toilet gets busted or you get a leaky pipe, or even your own personal healthcare expenses if you're off work. So just think about that and really not running it too fine for yourself.
There's plenty of calculators out there as well to jump online. You can test through repayments, get an understanding of what that monthly, weekly, fortnightly commitment will be, and that will get you ready financially for what might be ahead.
As an example, you can use the loan calculators. A typical loan term's 30 years, and you can use, say, 5% for your payment and just compare what that weekly repayment is, say, plus 10 to 15%. Compared to what you're paying at the moment now. So it's just a really good way to make sure if you're financially ready. The next point along is, even more importantly, will a lender think you're ready? Now, when it comes to getting a home loan, it's really important to think like the lender or the bank, because really they're the ones that are going to give you the money, and they're going to decide whether or not, not only if you can pay now, but if you can pay later, and also show if you've got proof. Nathan, what are some things that you think that the lenders look at to determine how much you can borrow?
You're right, Jayden. And with the lenders, they look at 3 or 4 criteria that needs to be met as the most important overarching themes. And they are: 1, what sort of deposit do you have? 2, what's your income and affordability of the loan? And 3, what are your liabilities? What are your ongoing commitments and ability to meet the repayments? Now, the first one, when we look at a deposit, generally speaking, you'll need anywhere from 5 to about 8% of the purchase price saved up. This is a give or take number. Most people say aim for 10% as a savings amount. And you know what? It can't really go wrong with a 10% deposit. Costs such as stamp duty vary from state to state. Most states have stamp duty waivers up to a certain purchase amount. Once you go over that, stamp duty does start to come in. So that's another thing to keep in mind. Lender's mortgage insurance is something that you do need to be aware of if you don't have quite the 20% deposit. We also look at other things such as guarantor loans, where you've got family that may be able to assist by the way of putting their property as a guarantee, which will alleviate the need for such a deposit. So there's a lot of different ways you can set it up. I think to begin with, aim to save about 10% of the desired purchase price, and that will give you a lot of options available to you and make it all happen.
There's also obviously first homeowners grants in different states. Now, these are generally on brand new properties. So in Queensland at the moment, there's a $15,000 grant that the government gives you towards your first home. So it needs to be on a brand new home. There's a few other caveats there. We'll include a link in this. But basically, that $15,000 can go towards as part of your deposit, which, like Nathan said, was that 5 to sort of 8% mark. So Nathan, next one along, income. So what do the banks look for with your income, and what do you need to be aware of there?
Interesting. The banks look at each category of income slightly different. So you've got your full-time and part-time employers. You've got casual, you've got self-employed. All of these are assessed and looked at in completely different ways. Now, generally speaking, with a full-time or part-time role, the banks will want you in the role for about 3 months. Now, once again, we're speaking quite generally. They want to see that consistency of income coming through, which will then be utilized in assessment. So when they complete an assessment, they're using your income to ascertain what your ongoing liabilities and expenses are compared to your income. That net figure will be used to determine your ability to meet a loan repayment. Now, if you're casual, once again, most banks will want to see a 3 to 6 month stint in the casual role. You've got to be careful with casual, as we've had clients that have taken 1 or 2 weeks off work. They come try and get a loan. The banks look at the year to date for casual employees. So that year to date is annualized and used as your gross annual income. So if you have taken long periods of time out, that can be something that reduces your ability to repay.
It's how much money you've earned in this current financial year. So it's worth keeping there. But I guess, like Nathan said, overall, probably one of the most important factors in income and employment is consistency. So another factor really to think about there is if you're considering changing jobs or careers even in the sort of near future, which we actually see more often than not, the lenders are going to want more than a couple of years history of your employment, and they might ask for additional stuff like a group certificate or a tax return to make sure that you're basically safe to give the money to. So the next one along, Nathan, is you said other debts and liabilities and repayments. So is that you're talking about like credit cards and personal loans and that impact?
Yeah, exactly right. So things like, even if you have a credit card and you have a $10,000 limit, that limit will reduce your borrowing capacity. So they're the things that might need to be reduced to ensure serviceability is met. The banks look at number of credit inquiries as well. So if you're going around every 2 to 3 months and doing a balance transfer on a credit card, that will have an impact on your credit file, reduces your score, and therefore impacts your ability to get a loan. So you've got to be careful with the number of inquiries you're doing on your credit file as well. So when the banks look at liabilities, they're not just looking at the amount owing, they're looking at your credit card limits, they're looking at the number of times you've gone to apply for credit, and they're assessing you as an applicant and your worthiness of being able to get a loan.
Yeah, no, it's great. So like you said, we've found even with, say, a credit card as small as $10,000, that can affect or reduce how much you borrow by up to $50,000. It can make a huge difference. So definitely now's the time that you've got a bit of time before you're buying to look at consolidating and closing down some of those credit cards that you don't need and you don't use. Because even though you might pay off a credit card every month and it might have a zero balance, the bank will still look at the limit or the total, the maximum amount you can draw out on that credit card. Another thing that we see people getting caught with a lot at the moment is Afterpay and Zip Pay. So although these might be, a short-term full repayment, you've bought a pair of shoes or whatever and not think about, the banks actually treat these like a credit card. And because they don't have limits, they can actually put their own self-say and say it's, you might use it for a $500 pair of shoes, but the bank might look at it as a $10,000 or $20,000 liability or credit card. So again, now's the time to start cleaning up and consolidating some of this stuff because it can really, really impact and actually affect you from being able to get your first home.
Another thing interesting, Jayden, is the fact that the banks are now utilizing comprehensive credit reporting. Now, if you haven't heard of this is where your data for your credit file is being reported both positive and negative. So if you've got a credit card as an example, even if you're 14 days late, now the banks know about it. So there's no more hiding from Big Brother. In the past, if you had bad history with one bank, you could avoid it by not using that bank that had the history on you by going to another lender. So that's another thing to keep in mind. Any debts that you've got, any direct debits, anything, ensure that they're paid on time.
Well, the crazy thing with that now, even if you close an account, they keep that history for 2 years. So like you said, if I had a credit card with St. George, I was missing the repayments on it all the time, then I close it, it's closed for a month, and I apply through another bank like ANZ, they'll actually see that on my credit file and potentially not give me that loan. So it's really important that, like we said, right now is the time to start consolidating and cleaning up this stuff and just being aware that all these little things actually can add up to making or breaking your loan.
Another thing the banks are looking at is your ability to meet repayment. So they call it propensity to repay. So this more or less in a nutshell means what's your ability to meet the current loan commitments based on your demonstration of savings and budgeting to date.
Oh, explain it to me super easy then. That's complicated, but I feel like I get where you're going.
Yeah, so effectively what the banks are looking at, if your mortgage repayment is $2,500 a month for the proposed purchase, they will look at the last 3 months of your day-to-day account history and see what your ability has been like to save that sort of money. Whether it be $2,000 to rent and $500 to savings, they want to see that ability, that history of you being able to meet that repayment.
In other words, they want to be able to see that, they're giving you a loan for $2,500 per month today, and they want to see that you've actually been more or less, either be it through rent or through savings, been allocating that $2,500 per month before you actually get the loan.
Exactly. So this is also good for yourself because it's like a mortgage broker, a mortgage on training wheels, where you can also give yourself confidence that you can meet that repayment. But this is something that the banks are looking into more and more seriously these days. So remember to try and start saving your mortgage repayment as towards your goals.
Good point. And then so our last point in this section is really how flexible is your time frame. So, like anyone that's young these days, we all want everything yesterday and we want to be in a house and start saving and growing assets now. But if one of the things we've highlighted in this before might be a problem for you, you might need to reassess that time frame and have a bit more flexibility around when you move out to improve, your credit score, to improve your savings, or to improve that whole consistency around your income or the propensity to repay, like Nathan said. And you've still got to search for that right property as well. So with all this stuff, if you need a second pair of eyes or you want us to have a look at your current situation and give you any tips or suggestions, or even just schedule an information session, just get in touch with us at our website, huntergalloway.com.au, and we can help you from there. Thanks.